Welcome to The Explainer. Today, we're cracking open the rulebook that the entire global economy runs on. It's the language every public company has to speak, but as we're about to see, there are some very, very different dialects. Okay, so let's jump right in with a puzzle that really gets to the heart of all this. How is it possible for two companies, identical in every way, to report completely different profits? It sounds impossible, right? Well, check this out. Both companies buy the exact same machine, but Company A only uses it a few days a week, while Company B runs its machine around the clock, wearing it out much, much faster. That wear and tear, well, that's a real business cost, and it's called depreciation. So Company B has a higher cost, which means, you guessed it, it reports a lower profit. The rules have to be consistent, yeah, but they also have to be flexible enough to capture what's really happening in the real world. So, if this is all a big global game, who are the referees? Who's actually writing this stuff and making sure everybody plays by the rules? Well, it turns out there are two main groups you really need to know about. It's basically a two-part system. On one hand, you've got the rule makers. These are independent, private groups that actually write the playbook. The big international one is the IASB. Then, on the other hand, you've got the enforcers. These are government bodies, like the SEC in the United States, and they're the ones who give the rules the force of law. All right, so we have the rule makers and the enforcers, but what makes these rules good? What's the grammar that holds this whole financial language together and makes it something we can actually trust? First up, the information has to actually matter. It's got to be relevant. That means it needs to be the kind of stuff that could actually influence a decision you're making, either by helping you predict what might happen or by confirming something you suspected. If it can't do that, it's just noise. Second, and this is a big one, the information has to be a faithful representation of what's really going on. That means it's got to be complete, no leaving out the bad stuff. It has to be neutral with no spin, and it needs to be free from any major errors. It's all about telling the truth.
And hey, this isn't just my opinion. The rule makers themselves put it right in their foundational documents. The entire point of this whole exercise, they say, is to provide useful information so people can make smart decisions about where to put their money.
But, it's not always that simple. There's this constant balancing act. Let's say a company needs to report its profit for the quarter. To do that, they have to estimate how many of their customers might not pay their bills. That information is timely. It's useful right now. But is it perfectly accurate? No way. They could wait a year to know for sure, but by then, who cares? The info would be useless. So you see the trade-off? It's timeliness versus verifiability. Fast, but maybe a little fuzzy, or perfect, but way too late.
And that tension really brings us to the central drama in the financial world today. This epic quest for one single universal business language and the huge walls that are still standing in the way. So on one side of this divide, you've got the International Financial Reporting Standards, or as everyone calls it, IFRS. It has become the standard pretty much everywhere. The European Union, Canada, Brazil, Australia, a huge chunk of the global economy is speaking IFRS. But there's a really big holdout. The world's largest economy, the United States, still speaks its own dialect. They use their own set of rules, known as U.S. Generally Accepted Accounting Principles, or US GAAP. And this creates a major divide. Now, for more than 20 years, there has been this massive effort to try and merge these two systems, a process they call convergence. And as you can see from this timeline, they've been at it for a while. They made a formal commitment way back in 2002. The SEC made things a little easier in 2007, but the original deadline came and went. Today, they're definitely closer, but yeah, that finish line seems to keep moving further away.
So you might be wondering, how big can these differences really be? Well, let me just show you a number. 20. What's that? Well, back in 2006, one Swiss company had to include an extra note in its US filing that was 20 pages long, and its only job to explain how its profits would have been totally different if it had used the American rulebook. 20 pages.
And here's the bottom line, literally. Take a look at this. For the exact same company, in the exact same year, the profit was $634 million under the international rules. But switch over to the US rules, suddenly it's only $504 million. That is a $130 million difference, created entirely by which rulebook they were using. It comes down to subtle things like how you account for employee pensions or business acquisitions, small differences that lead to a massive swing in the final number. Okay, so after all of that, why should you care? What does this all mean for you, for your wallet, and for how you make sense of the world? Let's bring it all home.
At the end of the day, these rules are what let us trust company financials and make smart investment decisions. They're what make it possible, or sometimes really difficult, to compare a company in Berlin to one in Boston. And on a bigger scale, this whole system of transparent, trustworthy reporting is the bedrock of stable financial markets.
You know, the goal of all these complex rules, all these debates, is actually pretty simple: to get the accounting numbers to reflect what's really going on in a business, to show the true economic reality as clearly as possible. And that leaves us with a final big question to think about. In a world that's only getting more complex, are we chasing an impossible dream? Can one single set of rules ever perfectly capture reality? Or will the language of finance always just be an approximation, where the real goal is just to get a little bit better at translating between the different dialects of business?